Greg, before the break, I had to cut you off. We need to go pay some bills. Now we're back. We're talking about Case-Shiller and some of the breakdown of numbers. Summarize that for me. Take the mic. Hit me with it.
Sure. Okay. So in a nutshell, there is a motivation to call the numbers as negatively as possible. And when you go through these stories, you find that they twist themselves into knots to come up with negativity when it may not be there. And in this case, it's not there. The housing market is cooling off. The same people who are saying that now, I mean, the image on the story I'm looking at is a sharply downward arrow in a bar chart, okay? Like a meltdown chart, right?
Right.
So
because that's what it always is. That's what happens. Like, hey,
I like pointing out I like pointing out things you can look at and say, gee, if there are that many holes in the story, like when Zillow had their recession in 2020 survey, if you'd read the survey, you found that less than half of the people surveyed, the economists, actually thought that was the case. So I don't know how you survey 100 people, 40 of them say there's going to be a recession, and then say economists agree, right? Mm-hmm. I don't know how you say that because mortgage rates went up in September, which is what Case-Shiller is saying. Because mortgage rates went up in September, that reflects negative numbers in September, which aren't negative. They're just rising slower than they were. But the numbers in September that Case-Shiller runs on is based upon real estate transactions that were negotiated in May and June. So the consumer behavior in May and June is reflected in Case-Shiller in September, not the mortgage rates going up in September. It's like impossible. People didn't find out about it until it was long after they did their deal and closed the transaction to buy the property. So they're gaming their own stats to spin things negative. You see things in it like we laughed a couple of weeks ago about this idea. There was actually somebody on TV talking about the slowdown in home prices, again, showing a downward trajectory. But all that's happening is they were up 6% last year at this time, and they're only up 5.5% this time. And the same people who are calling that kind of the beginnings of a free fall are the same people who 5, 6, 8 months ago were talking about how the market's too hot and how that's bad. The market's too hot. Prices are going up too high. That's bad. Oh, the market's cooling off. Well, that's bad. So you can't have it both ways. They try to have it both ways. I'm trying to be a voice of reason, not because I want people to just have rose-colored glasses, but because I believe that when it's appropriate to be optimistic, then it's correct to be optimistic. And it's not appropriate to be pessimistic about housing right now. It's a really, really good, healthy market. It's driven by consumer confidence, which is high. It's driven by good job security and low unemployment, which are both very strong. And it's housing in America. And I don't think anybody would argue that America's in demand. Right? Last time I checked, everybody's fighting over how to keep people out, how to let them in. I mean, the politics is all geared around fighting about people coming into the country, but one thing you can't deny is everyone wants to come into this country.
That's right.
And when they get here, they want to live under roofs. They want to live in houses with their family. And so it's just an incredibly bulletproof asset class that people who make their bones analyzing Wall Street, which is a volatile mess, try to apply a Wall Street mentality to analyzing housing stats. And I think they make fools of themselves.
Yeah, it's not going to happen. I was reading a little bit about I think we're looking at the same article here, and it's David Blitzer, managing director and chairman of the index committee, the S&P Dow Jones Indices. He also said, quote, sales of existing homes are down 9.3% from the peak. Housing stats are down 8.7% from November of last year. Okay, but I mean, we're still rising, like just not as quickly.
Sales of existing homes, well, let's break that down. Sales of existing homes are down 9.3%. From the peak.
Right.
So that means a year ago, it was the highest home sales. Nothing about that reflects home prices. The people who care about that number are people who get paid to sell houses. That's the number of homes that sell. Nothing to do with the prices. Housing starts are down 8.7%. That sounds bad. Well, that's people who build homes. Okay? It has nothing to do with people that own them and people that are buying them as investments. So there are 20 different stats you can seize upon. They pick two that sound the worst. And they know that people are going to misunderstand when they throw these numbers around that they're talking about home sales, new home building, and the home prices, by the way, are up 5.5%, which is higher than the national average, has been historically. Probably a little bit too high still, but they just don't understand it. So people ask why, and sometimes I vacillate. Why does the media do this? Is it because if it bleeds, it leads? Is it because they back a different horse in the political race, and so some people want the news to be bad no matter what's happening. You know what I think it's actually because? I think it's because they have no idea what they're talking about. I think it's just simple, smart people saying dumb things, because that happens, and it happens a lot in housing. So I'm going to give them the benefit of being honest and just a little dopey.
That's such a good way to put it. It's a really good point that you make, too. In the same report, prices increased 5.5% annually in September, down from 5.7% in August. Okay. So you're telling me that there's a 0.2% differential, but we're still increasing? Like, great. Thanks.
Yeah, it's fine. And by the way, one last thing, that we can move on to the callers. This is based upon a 10-city index. So this whole thing is based upon data in Atlanta, Charlotte, Cleveland, Dallas, Detroit, Minneapolis, Phoenix, Portland, Seattle, and Tampa. So my question is, what if you live in Iowa? How does this apply to you? Okay? They've got a different index that's Boston, Chicago, Denver, Las Vegas, Los Angeles, Miami. In other words, they're taking a small set. Like statisticians would tell you that extrapolating things from 10 cities to the national market is junk statistics.
Right.
Like they would tell you that in Stats 101 in college or in high school, they would tell you you have to have a sample set that covers the entire thing if you're going to try to use the data to extrapolate the entire thing. And they don't. And so it makes me mad. Because I want. Remember, we had a conversation a couple of weeks back about how whether I was trying to figure out whether I actually wanted to pick a fight with people who buy ink by the barrel. I feel like I might have done that.
I agree. In stats class, right? You want N, your sample size N, to be as high as possible, so you get the best. You could be looking at standard deviations. You could be, whatever you're looking at.
Listen to you, man. Wow.
I'm just saying, right? You got one standard deviation, you got the entire bell curve, 2 standard deviations, and blah. But you want a good sample size, right? Come on.
So
10 cities isn't telling me anything.
And here's the punchline. This is an asset class that is made for everybody, meaning it's not a Wall Street thing. We're giving people on our website the best data that the biggest investors in the world have. We give it away for free because we really believe that you need to know this stuff for yourself. You'll be led astray every single day by the media on the subject of the housing market. They have no idea what's going on. You'll be led astray by people in the real estate business because they're really about selling you a home to live in, don't really know that much about real estate investing. And you'll get led astray if you go to a seminar about getting rich quick in real estate. Just give me $10,000 for my coaching program and you can get rich. There's a lot of people giving the wrong advice. So here's my advice. Learn it for yourself. Trust people to help you learn, not to give you the end advice, but let this be something that you internalize as an investor so that you're using your own creativity, your own intuition, your own experience, your own mastery of the tools and the data. Because once you own this, you own it, meaning the knowledge, and then your kids are going to know it too, and everybody down the line. So learn it for yourself, do the homework, be in this.